This has been interesting only because we've been talking so long about this notion that the market was due for a pullback. Is this as bad as it gets, or could it get worse?
Hi, Dominic. Good to be with you. Well, first of all, let's just be clear what's happened, right? I mean, last year, the Fed was under pressure to actually ease off of the extraordinary stimulus, but they kept insisting on transitory, and we had this massive blow-off in equity prices. But underneath, the technicals were deteriorating for the last few months, even though the S&P still made a new all-time high in January. So what we're seeing right now is a major technical break on everything. We see also massive damage underneath. You cited some of the equity down moves on the indices. Underneath, it's much, much worse. We're seeing some of the most oversold technical readings we've seen actually in many years. So this is a fairly dramatic pullback on the technicals itself. And I think now it becomes basically a Fed gaming operation in the months ahead.
Do you believe, I mean, a lot of talk has been out there right now over the last several days about whether the so-called Fed put is still in place, this notion that if the markets really do fall that precipitously, that the Fed will step in with some kind of accommodative policy, some kind of easing. Is that in play this time? Does the Fed put still exist in your mind?
Well, first of all, the Fed put is basically a result of the Fed having acted very specifically on every market drawdown since 2009. The Fed put since then has been between 15 to 22%. So let's say 4,100 to 3,750. Now, what is interesting here in terms of the interpretation now going to five Fed rate hikes this year, I believe it when I see it, because all they're doing here is talking, and the Fed Chair Powell has actually not committed to anything. Really on this talk here in the last few days. They're talking about talking, and they're going to have a couple more meetings. Ultimately, frankly, what I think is happening here is with all these rate hike expectations being ratcheted up, there's actually a clever Fed put built into the market, because at the end of the day, and I said this at the beginning of the year, the easiest way to deal with inflation is to actually let equity markets drop, but not enough so that it causes a systemic event. And by markets dropping, you're actually tightening financial conditions. And that's exactly what's been happening. I mean, global markets lost $9 trillion in value in the last month, which is fairly significant, and it has an impact on the economy. We saw that in 2018 when markets dropped 20%. Guess what happened? Retail sales dropped, and the Fed switched policies. I'm not saying they're not going to raise rates. What I'm saying is that as these equity markets have dropped, it's going to take out some of the fluff and some of the excess, and it's going to impact retail sales as well. So over the course of the spring and then into the summer, they will be tempted to actually then ease off on these expectations, and that then acts as a rallying point for markets. So it's very clever how this is unfolding at this point.
So Sven, we know, you and I both know, and many folks and viewers and listeners out there know that trading and investing is much more nuanced. It's much more complex than just a simple, this versus that. But in many parts of social media, it's being boiled down to whether you buy dips or sell rips, so to speak. Are you of the mind right now that the market has deteriorated enough where you can buy on weakness, or do you feel that there's still a regime where anytime there's any kind of a pop, you should use it as a time to lighten up your positions?
Well, it's interesting as these corrections evolve. You got to be mindful of the technical signals. And on the NASDAQ, for example, we're now seeing oversold levels that are worse than during March 2020. It's pretty intense. We have other signals that suggest we're actually setting up for a rally. Of course, there's been a lot of technical damage done on any rally. You're going to run into major resistance points. For example, right now, the components of the NASDAQ below or the 50 MA, it's only 14% are above the 50 MA. It's a low point in many cases. But be aware, you got to look for pivots of control. One of them is the daily 5 exponential moving average on the S&P. We haven't been above it since January 12th. That's currently at 46.70. So we need to see the evidence of the market to start repairing itself and take control of some of these MAs. The other one is the weekly 5 EMA, which is also higher up. So you're in the bear phase until the market can get above some of these MAs and stay above them. And for now, every time we tag one of these MAs, it's been a selling point, and we need to see evidence of that behavior changing. And then you can get a bit more confidence that a low is in process of being made.